Hi everyone, my name is Jarrod McCabe. I'm an Associate Director at Wakelin Property Advisory. Good afternoon and welcome to From 1 to 2, When to Buy the Second Investment Property. Thanks for taking your time out of your day to join us. With me today is Stuart Wemyss, Director at ProSolution Private Clients. Good afternoon, Stuart.
Hey Jarrod, good to see you.
So we've allocated 45 minutes for this webinar. The plan is to use the first half an hour for a formal presentation. Stuart will consider the financial issues about investing for a second time. He'll also discuss the limitations of super when it comes to delivering comfortable retirement. He'll then work through the advantages of a multiple property portfolio and also provide guidance on when it is financially prudent to take on more assets. And then finally, he'll share some tools about working out a budget for the next transaction. I'll then talk about selecting the perfect second asset, one that complements your previous purchases. We'll then devote the rest of the time to some questions that some of you have put forth to us. Okay, Stuart, it's over to you.
Thanks, Jarrod, and good afternoon, everyone. I'm a licensed financial planner and chartered accountant and also mortgage broker and registered tax agent. So I'm trying to bring a holistic approach, tax and financial planning and borrowing and so forth. They're all considerations when developing a strategy, investment strategy, and also a property plan. So over the last 14 years, I can certainly lend on that advice. Anyway, without further ado, we're here to discuss how to move from one to the second or multiple investment properties. And really the discussion has sort of two limbs. Firstly, the first limb is really, do you need more than one investment property to fund retirement? And then secondly, if you do, how do you know when the right time to purchase or invest in that? So I'd like to start the presentation with really talking to, do you really need another investment property? The first point obviously would be that most people, in terms of funding retirement, would have a pool of assets inside super to do that. I mean, that's obviously the sole purpose of superannuation. And then a pool of assets outside super, typically property, or it might be shares and cash and so forth, that go hand in hand. Now, one of the key considerations in determining how many properties you need to invest in will be how will your super perform and how much of the retirement phase will your super fund. And I guess there's three considerations that sort of come to the fore more recently about that. The first one is that the average or mean super return last year was only about 3%. And most of those returns came from other assets such as private equity or property or infrastructure. Infrastructure had a really good year. But if we're just talking about the main assets, which is really international shares and domestic shares, well, the US market lost ground last year, and the US makes up about 60% of the international index. So we didn't make any money from international shares, and the Aussie market was held just about even. So all we got was really the dividend yield. There's also more reporting or I guess arguments coming out that we can't expect the same growth rates over the next 30 years than we have enjoyed over the last 30 years. Deutsche Bank recently released a study over the last 200 years of data suggesting that the next 30 years of growth will be sluggish at best. JP Morgan last month also backed off its long-term asset forecasts, something that they produce every year. And closer to home, Russell Investments, another fund manager, also believes that longer-term returns will change even in the residential property space. I'll remind you, Russell Investments are managed fund providers, so of course they've got a vested interest in being negative about property. I guess the issue really is about how the world economy is going to stimulate economic growth, and therefore equity markets tend to obviously follow that. The problem is that we would be stuck in a zero or low interest rate inflation environment for an extended period of time, noting that monetary policy, so that's really interest rates, levers have already been pulled by most of the large economic nations around the world. Interest rates are virtually 0%. And fiscal policy, which is really government borrowing and spending money to stimulate economies. Again, sovereign debt around a lot of these large nations in Europe and US and so forth are also very high. So what other levers does the government have to pull to try and stimulate the economy? The US market's showing some signs of reasonable growth, but then they've got some political uncertainty, don't they? So in terms of what's going to happen with Trump and so forth. So I guess looking further out and working out, what is your super balance going to do over time, and what that balance be by the time you get to retirement? Maybe we have to back off some of that growth. Secondly, the amount we're able to contribute into super over the last 10 years has it really been pulled back. In 2007, when the Howard government was still in power, individuals could contribute up to $50,000 a year. So really a married couple could between themselves could put in $100,000, pretty considerable really. If the laws will soon be passed that for everyone that'll be reduced to $25,000 a year. And people earning over sort of $250,000 pay twice as much tax, 30% as opposed to 15% on their contributions. So it's a lot harder to get money inside super. And the last concern or consideration probably is your longevity risk, that is outliving your money. The average 60-year-old today can expect to live to sort of mid to late 80s. Obviously, if you've lasted till 60, you've avoided some of the risks that many people have to negotiate, I guess, throughout their life. So life expectancy is more known, if you like. But life expectancy increases in line with income and education. So the more income you have and the more education you have, typically or statistically, the longer you live, which is probably bad news for property advisors, Jarrod. Anyway, so if you're in your 60s today, or you're at 60, you might have another 25 years of life to fund from a retirement perspective, but it would be reasonable to expect that there's going to be some medical advances over the next 20 or so years. IBM launched a cloud-based artificial intelligence computer called Watson, and last year they came out and said that they're going to start applying that on a commercial basis, and in 10 years' time, they believe Watson will generate over $1 billion in revenue. Over the last 12 months, Watson Oncology has been developing treatment plans in minutes that would normally take a group of specialists many weeks to do, and the more information and cases it gets fed, the better and more accurate it becomes. And IBM just bought a radiology business that has over 30 billion images that Watson will now start working through, and Watson learns just like a normal human brain, or well, at least some human brains. And so the more information and more experience it gets, the more powerful it becomes. Now that's just one example over the last 12 months of what's happened. So you can imagine the growth or improvements in medicine will be exponential. So how long then does your super have to last? So I considered a case study of your average sort of 40-year-old at this stage that has $200,000 in super at the moment, will contribute about sort of $10,000 a year. So that could be either their 9.5% from their employer or additional contributions. We'll take an average earnings rate of 6%. By the time this person gets to 60, their super will be $870,000, which sounds pretty good. If we assume they need about $40,000 in today's dollars to fund living expenses, and that's assuming this person has a spouse that's maybe contributing the other $40,000, because $40,000 typically wouldn't be enough for two adults to survive on. Unfortunately, this person's got a decision to either die at 82 or live on the age pension, which is only $23,000. So clearly the conclusion here is this person needs to either make more super contributions or invest in other assets. So one of the compelling reasons to invest in more than one property will be your super's just not going to do enough of the work. Another benefit of owning more than one property is the advantages that it brings. And the first, and I think probably the most compelling advantage from my perspective, is the ability to reduce your investment assets and therefore reduce debt while still having some money invested in the market. So if you've got one property, your decision either is to sell it or keep it. And if you sell it, okay, you've got zero investments, obviously, until you reinvest the money. If you've got two properties, you've got the option of keeping one and selling one. And I think this is a really important option in case super returns don't work out as expected, or cash flow doesn't work out as expected, or performance doesn't work out as expected. And to demonstrate this point, just using really conservative numbers, if you went and bought two $600,000 properties today, in 17 years' time, you could sell one of those properties, and after paying the capital gains tax and repaying, you'd still have enough to repay both the loans used to purchase those properties. So in 17 years' time, your $600,000 property will be worth about $1.6 million at a modest 6% compounding growth rate, and you'll have no debt against that property. Now, you might want to keep both properties, and carrying the debt at that point in time might be fine for your circumstances. I'm not suggesting, but it's a plan B, if you like. Some other advantages of holding multiple properties is really smoothing returns, which Jarrod's going to talk about in a moment's time. So that's really about not being single point sensitive. So the different assets are going to perform differently at different times, at different locations, and it's important that you can smooth those returns out, not only just from a comfort level perspective, but also from a borrowing capacity perspective, so it helps you to continue to build your portfolio, and obviously reduces your risk because you're not single point sensitive. And the last sort of point might be, which is a more common conversation we're having with clients, is about sort of helping their children later in life get into the property market. So you might notionally ascribe, one property to sort of help fund your retirement, one property to sort of help your children. The last consideration of, should you buy another investment property really depends on your destination. It's very difficult to ask someone for directions if they don't know where you're heading. So it's really about understanding, okay, what does retirement look like? At what age would you like to stop or wind back working hours? And how much do you need in retirement to fund the lifestyle that you're looking to fund? The first comment will be in terms of retirement age. Commonly, the answer or the response from clients to me is, look, Stuart, I'd like to have the ability to reduce my working hours from age 60 onwards. I'm not necessarily going to stop in full at that time. What I try and do in that circumstance is develop a retirement strategy that gives that person the flexibility to stop in full at that time, knowing they probably won't do so. What else are you going to do? You're going to sit on the couch, you've got to have something to do. You might prefer, therefore, to go down to 3 days a week and have 2 days a week off or something like that. But develop a strategy that allows you to have complete flexibility. Secondly, in terms of determining how much you need, well, that's obviously going to depend on your goals. A good starting point is how much you spend today on general living expenses. Then make the adjustments for the things that might not be around at that stage, like children. Hopefully children have left by the time you reach retirement, left home. But also you'd have to add additional expenses for other things like travel or so forth. Typically, we find people are aiming at somewhere between $80,000 to $100,000 a year after tax to fund retirement. And then lastly, consider how a stronger asset base is going to give you more flexibility and comfort later on. So you're in the situation where you need medical care or you need to go into sort of special care arrangements. If you've got a strong asset base, your family doesn't have to worry about how that's going to be funded and so forth. So that really concludes the kind of the first part of the presentation, which really talks to, do you need to buy another asset? And really comes down to your existing assets and also your longer term goals. Let's assume now we've determined or decided we do need to buy another asset. We now need to start thinking about what are the considerations to work out if now's the right time. So the first point I wanted to make is that I want to make two actually contradictory comments. The first one is that interest rates are at historic lows, particularly fixed rates, and would be silly not to take that into account in terms of the timing of our investment decisions. And my contradictory comment to that, I should say, is that don't get seduced by low interest rates. At some point they're going to rise. Everything's cyclical, like particularly financial matters, and we need to make sure that we're borrowing sensibly. And so what I would like to do is mount or propose a strategy that takes into account both those arguments. So on the page here, you'll see a graph, and the red line projects what a $600,000 investment property is going to cost you after tax, assuming a 7% interest rate. And I typically use 7% as an interest rate to do long-term planning. And it will cost you about $360 a week after tax. The blue line, however, looks at what that would cost if you fix your rate for 4% for 5 years, for the next 5 years. So that's the current investment 5-year rate at the moment. And that reduces the cost to $135 per week. So significantly lower, right? So 40% of the total amount. And after 5 years, you see that blue line tick up, going back to the 7% line. So we're assuming there, after the 5-year period, interest rates will go back to normalised levels. The black horizontal line that you'll see just below the $200 mark is the average cost over the first 15 years of holding that property, assuming you fix the rate for the first 5 years. So essentially what I'm saying is if you can make friends with a $600,000 property costing you around $200 a week, say about $10,000 to $11,000 a year, then now's a good time to invest. Because obviously over the next 5 years, it's going to cost you a lot less than that, in which case it allows you to build up a cash flow buffer so that you're able to weather the storm when interest rates are higher. But on average, and I've been really conservative with my numbers, it shouldn't cost you more than $200 a week for the next 15 years. Now, just lastly, I'll say I have been quite conservative in terms of the growth rate of the property, and that's why you can see it takes 20 years to turn positive cash flow. Typically, from experience, an investment-grade property should start turning positive cash flow in sort of the first 10 to 15-year period. So 20 years has been really conservative, but I'd rather be conservative than bullish. So the first thing you need to work out is, can you afford another property? So can you afford it from a borrowing capacity perspective, and can you afford it from a practical cash flow perspective? So the first thing you need to do is work out what your surplus cash flow is. That is, how much cash flow you've got left over each month or week or fortnight after paying for living expenses and your existing commitments. The easiest and simplest way to do that probably is just to go back and have a look at the last 3 months of bank statements, money in, money out, and average it out, obviously making adjustments for any sort of one-off or lumpy types of expenditures. And that'll give you a good sense of what your surplus cash flow is. If we know a property is going to cost us $10,000 to $11,000 a year, then we probably want to build in a bit of a buffer. So we probably want to see a surplus cash flow of somewhere between $11,000 and $15,000, I would have thought. Also, there's lots of things that you can do to manage the risk, the cash flow risk of holding investment properties, and things that you can consider obviously is fixing in rates. I mean, that protects you for 5 years, but you still need to consider what happens after then. Allowing for large buffers in loans, so that is unused credit facilities or credit limits that you can draw on at any stage. In case, you temporary loss of income or large lumpy expenses. And make sure you have adequate insurance, income protection insurance in particular, and obviously landlord insurance, so that you're protected in case you have an accident or an illness. The last thing to consider from a practical perspective, from a borrowing capacity perspective, is how much the lenders will lend you, and be warned that the banks have certainly pulled back borrowing capacity quite considerably over the last 12 to 18 months. And a person's borrowing capacity is probably halved over that period of time. So certainly speak to your mortgage broker, or I should say ProSolution, in respect to that. The next thing to consider is, once you've considered cash flow, is to consider equity. You need both cash flow and equity together in order to really qualify for being able to invest in the property. And as a general guide, you need about $120,000 of borrowable equity to invest in a $600,000 property. So let me take you through very quickly, and I'll use an example in a second, how you calculate your borrowable equity. Essentially, it's the total value of properties multiplied by 80%, less your existing loans equals your borrowable equity. In fact, I'll go through a very sort of quick worked example right now. So assume your home's worth, say, $950 and you've got an investment property of $650. So total value of assets is 1.6. You multiply that 1.6 by 80%, gives you 128, $1,280,000. If your home loan is 227 and your investment loan is 600,000, so therefore you've got total debt of 827,000. You take that number away from the 1280, and your borrowable equity is 450. So in this circumstance, comfortably can access at least 120,000 to fund a deposit. A couple of caveats here. Firstly, bank valuations are likely to be conservative, so be conservative when you come up with your numbers or when you use your numbers. Secondly, banks will take into account unused credit limits, redraw, any sort of credit or limit rather than the actual balance. Now, you've got the option to reduce those credit limits to equal the balance, but also be mindful of that in your numbers. Lastly, you still have to obviously demonstrate that you've got the income to service the debt. So for people that might be very equity rich but cash poor, they've still got to deal with the cash flow element to maximising their borrowing capacity. If we've decided, okay, we've got enough surplus cash flow, we've got enough equity, what next? The next thing is, setting a budget. How much do you spend on this next or second or third or fourth investment property? And really the answer, unfortunately, is the best answer is it depends. And it depends on lots of different considerations. And I'll go through some of these now, but really you probably need, you do need sort of specific advice in this regard. You've got to consider future changes to your financial position, like starting a family. So if you're going to go down to one income and expenses are going to rise, you might want to be more conservative rather than aggressive at this stage. Changing jobs and income, that could either be positive or negative. Likelihood of income increases, you might feel a little bit more confident going a little harder now, knowing that you've got some set income increases coming your way. Existing investment assets is a really interesting one. So, if we develop a strategy for a client that dictates that they need to buy, say, 2 investment properties, we want to spread their budget across those 2 investment properties, and having that foresight allows us to then set the budget for the first one with the second one in mind. However, if you go and exhaust all your budget right from the get-go and put it all into one property, maybe then you don't have the flexibility to go for a second. And the same applies for a 3-property or 4-property portfolio. So it's really about how many properties do we need and what's the budget we need to kind of set today. Obviously, your cash flow is going to dictate that. Someone with a very strong cash flow it probably has the capacity to go harder sooner. And like I've spoken about already, sort of what are your goals, time to retirement, and risk profile and tolerance. Probably the comment I would say there, if you're nearing retirement, you really do need to give consideration to the cash flow impact of investing heavily in property now. Because property needs time, as I've shown in the graph previously, and you need to allow at least 10 to 15 years for the property to start at least paying for itself. So if you're 5 years away from retirement, investing heavily into a property today is actually going to create a negative cash flow and might create a situation where you're forced to work longer than you really wanted to, or you need to draw on super more aggressively in the early years of retirement. Neither is necessarily a right or wrong answer. It's just about having clarity on what is going to be the impact in the next 5 to 10 years on the decision today, and set your budget in connection with that. So in summary, there's kind of 3 rule of thumbs, I guess, that you can apply to working out, should you add another investment asset to your portfolio. The first one is how important or urgent is it for you to do so? So that really goes to what is your longer term plan? What existing assets do you have at the moment? How will those assets perform or how will you think they will perform over the period between now and retirement, or when you want to start retirement? And do you need to add more assets into that pool? So again, using the example that I started with in terms of the 40-year-old that had $200,000 in super, that was going to run out of money at age 82, it's obviously pretty urgent for that person to start investing today. The second one is, do you have at least $200 a week of surplus cash flow plus a little bit of a buffer? If you do, then you can take advantage of really the low interest rate environment today and set your holding costs a lot lower than what they would have been in history. And third, do you have at least $120,000 of borrowable equity? Or a family guarantee. So if you're equity poor but income rich, an opportunity is to potentially, excuse the pun, but borrow against the equity in your parents, or if you're lucky enough, siblings' properties to help secure yours for a period of time until which your properties have increased in value and you can release that guarantee. So something to think about if you're income rich but asset poor. So that's enough from me. I'll certainly come back and answer some questions later, but I'm going to hand over to Jarrod now, who's going to devil you with his property knowledge.
Yeah, thanks very much, Stuart. Okay, so my colleague Richard Wakelin has a very well-used saying that we hear quite regularly in this office: buy, hold, never sell, and repeat the process. So underpinning these words is a truth that if you accept the reasons for investment, so gaining financial security and more autonomy over what you do with your life, then once you start, you really should keep going. But before embarking on a second acquisition, and notwithstanding the never sell rule, it is wise to review your current assets first. So if your first property investment, is it performing well, or is it a case of perhaps we need to offload it and start with a clean slate? Okay, so about buying the property the second time round, you really need to resist the temptation to be speculative with your second or third purchase. And we'll discuss diversification shortly, but you really do need to select assets or selecting assets, sorry, without a proven track record of capital growth. It's not really diversification, it's really just poor discipline. So stick to the tried and tested and proven methodology. So focusing on inner city suburbs where there is a real scarcity value of the property, whether that's older style apartments in select low-rise blocks or perhaps period housing, so Victorian, Edwardian, single-fronted houses, or perhaps even semi-detached Art Deco houses. And there's another couple of factors that will help to shrink the pool of properties, because obviously that doesn't narrow things down too much. First off, Stuart's obviously discussed with you that the process of calculating a prudent budget, and budget will obviously determine whether the next property is then going to be a one-bedroom or a two-bedroom apartment, or perhaps a two-bedroom or three-bedroom cottage or terrace house. So if your budget is going to be in excess of $1 million, then it's likely that you would be focusing more on a house, but that will, to an extent, be dictated by what you've purchased previously as well. If your budget's between $600,000 and $1 million, then it's most likely going to be a two-bedroom apartment, although there are some very high-end one-bedroom apartments that fall into that price range. And if your budget's between $400,000 and $600,000, then it will most likely be a one-bedroom apartment. Now, for the second-time investor, the other consideration is obviously diversification. And that comes about as to what your first purchase was. So we need to look at then the size of the property. So was it a one or a two-bedroom apartment? What style was that property? Was it a 50s, 60s apartment, or was it an Art Deco apartment, or perhaps was it a Victorian house or even an Art Deco house? We need to look at all these considerations. And you do need to remember that the market, from a property perspective, does not perform uniformly across the board within a city such as Melbourne. And that's where diversification comes in. So it is important to have diversity, not just geographically. So it's not buying something, for instance, and having a house in Brunswick is great, but it's not just then about buying something in Hawthorn. It's about buying the property that fits into the Hawthorn market. So, for instance, a 50s, 60s apartment that can perform quite well in Hawthorn, or even an Art Deco apartment. But it's not just about the geographical location. So that gives you a bit of an overview as to the importance of diversity and structuring your portfolio correctly when buying the second and third property. But that pretty much brings us to the end of our presentation for today. But what we will do now is answer some of the questions that have come through before today's event, and then also have a look at if we've got time to answer some of the ones that came through during the presentation. Okay, so first up, I'll start asking Stuart first off. So is it better, Stuart, to build an investment property portfolio inside or outside of a self-managed super fund? And if you can factor this in, how do we decide what level of gearing is safe?
That question's almost a separate webinar in itself, probably. Obviously, it depends on the person's circumstances and goals and so forth. But I can probably just talk to, some of the considerations that I'd take into account when trying to answer that question for a specific person. The first thing I'd say is that diversification is the key to lots of things, not only financial but in life in terms of managing your risk. And diversification in terms of ownership structure is important too. So having all your eggs in one basket's not necessarily a great idea. One of the issues, I guess, with being too super-centric, having too many assets inside super, is that you start to become really at risk at legislative changes, and the government's always moving the goalposts when it comes to super. One of their more recent proposed changes is to tax people that have more than $1.6 million in super differently to people that have less. So I think by tying all your wealth up inside super is probably waving a little bit of a flag to the government to say, hey, tax me a little bit more. Secondly, I like the element of having diversification. You've got more control of assets outside super than you do inside super. There are some benefits, however, of having property inside super. And one of the main benefits at this stage is that potentially you can sell that property in pension phase, so in retirement, and not pay any capital gains tax. And if we're buying capital growth orientated property, then capital gains tax can be a pretty significant bill. So, if your strategy is to buy 3 properties and sell one, the one that you've earmarked to sell in the future might best then be owned inside super. In terms of a safe gearing ratio, again, it's going to depend on your age and your contributions into the fund. But what you do need to consider is, will the fund have enough liquid monies, so cash and shares and so forth, to be able to start paying a pension, which is a minimum pension of 4% of the balance by age 60. So what you don't want to do is go too hard in gearing so that you don't have the capacity to convert your fund into pension phase. A little technical, but essentially we want to be a little more conservative with our gearing ratio inside super than we would outside super, which again dictates, or gives us a good reason of why we might want to spread that risk. Jarrod, I think there's a question here from Philip to you. Should your potential second investment property be cheaper so it's closer to positively geared, or perhaps in a rural area?
Look, buying in a rural, buying the second property being cheaper doesn't necessarily mean that it needs to be focused more on a rental return, so positively geared. A cheaper asset, so relative to what you've purchased the first time, so for instance, buying a house first time round and then buying an apartment second time round is absolutely fine and can work very, very well, because it does come back to that point mentioned earlier about diversification. But it still doesn't change the strategy around focusing on capital growth focused assets as opposed to rental focused assets. Buying in a rural location, that can certainly be used as a stepping stone. I would look at that more on an entry level to buying a first investment, to then being able to step into the Melbourne market where capital growth will be far stronger. But I wouldn't be looking at buying a second asset in a rural or location, because you aren't going to be building equity which will enable you to buy perhaps a third and even fourth property going forward. So, yeah, Stuart, you add anything to that?
Philip, I think if you're buying the second property and you'd like it to be positively geared, I'd imagine what you're trying to do is try and balance out the cash flow in the portfolio. Property is a growth asset. It's always going to be a growth asset. It's not an income style asset. So it's going to be a very difficult strategy to implement from that perspective, because you're never really going to get a massive yield from a residential property. There's 2 sort of comments there. Firstly, a better strategy is to have capital growth style assets in our personal names and income style assets in super. So if you're worried about having more income in retirement, then maybe you should change your asset allocation inside super. Or secondly, maybe residential property is not the right answer for you. Maybe there's some other income style assets that you should be investing in if you want to balance out. But I think actually that almost always that the first answer is right in terms of invest for capital growth outside super, tilt your super towards more income style assets. It's more tax effective in that way too.
Great. Okay, next question for you, Stuart, is from Jan. How much cash flow should one reserve after purchasing the second investment property?
I'm going to assume that the question's asking me how much cash is either left over or how much sort of annual cash flow buffer should you have, should you retain, I guess, for unexpected changes. To answer the first bit is, I typically like to encourage my clients to have at least 6 months of living expenses in cash savings. So that provides a nice safety buffer, and as long as then they've got the appropriate insurances in place, like income protection insurance, then we've covered off most of our bases. In terms of surplus cash flow, it's going to depend on your own circumstances. It's going to depend on your job security and stability, your income stability, the potential of your income to grow, and your sensitivity to interest rate rises. So they're the things that we want to consider. But for example, if I had someone that didn't have much in the way of borrowings and they had a $15,000 surplus income, to allocate 2/3 of that, so $10,000 towards an investment, I'd be pretty comfortable with that, leaving a $5,000 surplus. With someone that had a lot larger sort of debt exposure and therefore is more sensitive to interest rate increases, then maybe I'd want a higher buffer level there. Sorry, I can't be more specific. Jarrod, David's asking, is it a good time to buy a 2-bedroom apartment now that there's lots of off-the-plan properties that are coming onto the market and that have come onto the market? Also some related questions there from Paul and Leonard.
I'll start with David. It is a good time to be buying 2-bedroom apartments at the moment. However, David, I wouldn't be buying the ones that are coming onto the market off the plan 6 years later. There's still a huge backlog of new developments that are to be constructed in and around Melbourne. So that flow on and that increased supply level is still going to continue, and that's what you'll be competing with for a long time into the future. But 2-bedroom apartments in the older style market, when we're talking about boutique type blocks, quiet residential streets, but still well located in proximity to local villages, public transport, that sort of thing, are very much good value, and there's some very good opportunities around at the moment in that sector of the market. They have much larger portions of land value to the end purchase price, which will drive capital growth going forward. So there's certainly some good 2-bedroom apartments around to be purchased, but I certainly wouldn't be buying the ones that are in the high-rise type developments or have been in off-the-plan purchases within the last 6 to 8 years. And Paul, your question there around the recent heat in the Melbourne market, is it a good time to buy? We always talk about buying real estate. You buy when it suits you, not when you're trying to time the market when it's perhaps at its peak or when it's trough. It's always a long-term focus. It's never a short-term investment strategy. So buying, if now is the right time for you from a financial perspective, get into the market and let the market do its thing for you going forward. But it should always be a long-term strategy, minimum of a 10-year type hold. Now I've got another question here, I think, for you, Stuart, from Robbie. Is there an ideal purchasing formula, e.g. price versus rental return versus loan gearing versus offset balance to maximise investments?
That's a good question, Robbie. I don't know if there's any specific rules of thumb that apply across the board. I mean, really what we do to develop a financial strategy is we use a financial model to do that. So we sort of model out cash flows, inflows and outflows, and then allocate those over the person's working life, and then to work out, what sort of assets we're able to then accumulate over that time and how that behaves in retirement. So the cash flow model is really the foundation for doing that. I guess some things I look for when I'm modelling these things is firstly, we want obviously the home loan to be repaid for clients, and so we want to have enough cash flow over time to get rid of all non-deductible debt. And the second one would be, we'd want the property portfolio to be neutral by the time they get to retirement. So we don't necessarily want a lot of income from the portfolio, but we do want it to pay for itself. So typically you're looking at a loan-to-value ratio or gearing ratio of sort of 50% or below in order to do that. The reason why we don't want the property to be neutral, at least neutral, is that we can then allow us to draw from super more aggressively, knowing that the property is still performing and still working away behind the scenes. But we don't want a lot of interest rate sensitivity in retirement, because obviously with all our income's coming from passive investments, and that's not going to move in line with interest rates. So we could get caught out if we've got a too high level of gearing there.
All right, we've got time for one final question, Stuart. This one's coming during the webinar. What are your thoughts about establishing a trust to buy property? Would you use a corporate or individual or corporate structure? That's come from Roger.
Thanks, Roger. Well, like all my answers, I'm going to say it depends. But if I'm going to have a trust, I'm going to have a corporate trustee. That's just for asset protection purposes. I'll go into more detail about that. But would you use a trust? Well, if you're PAYG, so if you're an employee, you probably wouldn't, because the negative gearing is sort of trapped inside the trust. You don't lose it, but it means you carry it forward. And if you spreadsheet these things, it means that really you don't have any tax gains or benefits for a 20-year period, whereas if you have it in your personal name, you get to save tax today, and $1 saved today is worth a lot more than it's saved in 20 years' time. The other consideration is that land tax is a lot higher for properties held in trusts than in individual names. In individuals in Victoria, we have each individual has a $250,000 land tax-free threshold, so we should at least utilise that. If you're self-employed and you've got the ability to sort of direct taxable income into a trust structure, then maybe it's appropriate. Again, I typically try and go for diversification, so we want to spread our assets across a few different ownership structures.
Okay. So, well, we're about out of time for questions. Stuart, I know you wanted to make mention of a new ProSolution service that you're offering.
Yeah, sure. Thanks, Jarrod. Essentially, what I've sort of said throughout the presentation is go get yourself some advice, and certainly respectful if you've got an existing relationship someone that's independent that you can trust. If not, then I just wanted to flag that obviously we're here, we're willing to have the conversation with you, I'm willing to have the conversation with you. Probably 2 pointers. That the first one is that we maintain complete independence. So my business doesn't earn any more or less money irrespective of what our clients invest in. We have nothing to sell you other than our advice. So whether it's property, shares, super, managed funds, whatever it is, we don't have any conflicts of interest there. And just by way of a bit of advice, if you're going to get financial advice, take the conflict out of it. Make sure you're going to someone that doesn't have something to sell you, isn't conflicted. And the last thing is the work that we choose to do is really work with clients on a long-term basis. So the most rewarding thing for myself and for the staff in the business is really to meet a client today, so that in 10 years' time we can look back and say, oh, look at the road that we've travelled, look what your asset position was when we met you, look what it is now. We obviously won't take credit for all the upside. Jarrod's going to take plenty of that, but at least we can sort of share in the journey and see that we've made a difference to someone's life. Now I know that that sounds all well and good, but we can do lots of different things for lots of different people, but that's the sort of work that we choose to do. So we don't do sort of piecemeal financial advice in terms of answer a question and you go off on your way. We're very much about building a long-term relationship. If you want to find out more, just go to our website /WC, which stands for Wealth Coach, and there's lots more information there, or contact our office anyway.
Great, thanks, Stuart. So on behalf of Stuart and myself, thank you very much for your time, interest and contributions today.